The one obvious factor of this market downtrend is after the left-right combo in the Dow, closing below the T-line, it bypassed the first support level and went to the second support level. Notice the bullish haramis that told us the selling had stopped. Now at that level, you have to analyze whether there's going to be a reversal or whether it's just a bounce. In this case, some oscillating days in here. And one major factor that could be revealed was they couldn't close it above the T-line. Now we're sitting down here right on a potential support level, telling us that if they open it positive, this is probably a support level. They're going to bring it back up to test the T-line one more time. If they open it lower, now you've got the continuation of your bearish J-hook pattern taking you down into this area. The same things can be revealed over in the NASDAQ. Bearish engulfing hit a level, bounced back up to the 50, failed, now has the potential of wave 1, wave 2, the failure of the 50 putting you into a blue ice failure, makes the 200-day moving average your next likely target. Now the problem with this area, as you can see, is you have up days, down days, up days, down days, all based upon presidential tweets or everybody getting scared about the inversion of the interest rates. But the overall factor is investor sentiment can still be clearly identified as not getting back up through the resistance levels that were in a pattern that could take you down to this level. Knowing the markets are oscillating, you want to find patterns. Notice how Tesla had a wedge pattern breakdown through the downside. So you have a wave 1, a wedge wave 2, going into wave 3. There's some gaps to fill over in this area that could be your next likely target. But not knowing whether the market's going to keep oscillating, at least you can go after the strong charts or the strong patterns that are probably going to disregard what the overall market is going to do. That same scenario was applied to our recommendation to short TLRY. Yesterday, it did a kicker signal, a bearish kicker signal, and a strong one. Notice the gap down, opened here, closed here, opened well below the previous day's open, and went the opposite direction, one of your strongest candlestick reversal signals. This should have a lot more downside because not only is it a bearish kicker signal, but notice they're trying to come out of this with great enthusiasm, a lot of strength in your downward movement. This also will be less influenced by what the overall market trend is doing. Anytime you can see where the selling is occurring, like in AMD, you kind of had a resistance level right here, and they sold it off. Then they did a bearish doji sandwich gap down, implying also that this is probably your next, at least your next target, and possibly down here. So the more pieces of evidence you can put into your visual analysis of when the signals are occurring, the higher the probability that everybody else is watching what's going on at those levels and either buying or selling at that time. And there's always patterns that even though the market is heading down, like our recommendation on ZYXI was based upon a morning star signal, a bobble type breakout, then a doji sandwich. If it traded positive today, it would be breaking this level, putting you into the next wave of this chart. So the advantage we have with candlestick analysis is you can go through the 10,000 trading entities in the matter of minutes, finding still very strong buy signals in a down market, as well as the best sell signals in a down market. That'll be it. We'll see you in the chat rooms.